The US dollar's historic plunge has sent ripples across global currency markets. As its dominance falters, investors everywhere are asking how far could it actually fall and who stands to gain. With President Trump renewing his attack on the Fed chair to step down, this year marks the dollar's worst performance since the collapse of the Bretton Woods system in 1971 to 73. The real question brewing is, will Trump's call for a 1% interest rate backfire on the US economy and hurt the dollar even further? Trump has renewed pressure on the Federal Reserve, insisting the central bank should slash its rate to 1%. In fact, he argues such a move would cut government borrowing costs and help finance the ballooning deficits driven by his administration's spending and tax cuts. But economists are warning that this demand could spell serious trouble for the world's largest economy. Trump's push for ultra-low rates risks undermining the Fed's credibility, and experts have called a 1% rate a crisis-era level, but they argue that there is no crisis or recession now. Historically, a 1% Fed policy rate has been allocated with moments of genuine economic distress. The dot-com crash, the aftermath of the 9/11 attack, the 2008 global financial crisis, and the COVID-19 pandemic, none of those conditions describe the current US economy. Lower rates could reignite inflation and rattle investors in the $36 trillion US Treasury market. That market is a critical source of funding for the federal government. The dollar could fall into a debt spiral and lose its status as a global reserve currency. More importantly, the Fed's job is to maintain price stability and full employment. The Fed's mandate does not include making it easier for the government to borrow at lower rates. Cutting rates sharply when the economy is not in recession could actually spur demand, just as new tariffs risk pushing prices higher.
To stay up to speed with the latest news, download the WION app and subscribe to our YouTube channel.